Hello, and welcome to the OTCQX educational webinar on superior corporate governance and disclosure practices, with our guest speakers, Mark Collinson and Elaine Ketchmere, two of the partners from Compass Investor Relations. I'm Bob Power, Vice President of Corporate Relations at OTC Markets Group. And now, I'd like to welcome Mark Collinson and Elaine Ketchmere, two of the partners at Compass Investor Relations. Welcome and thanks for joining us as featured speakers.
Thanks, Bob. Thank you so much. And let me start off by thanking OTC Markets for inviting us to present today this webinar on corporate governance and disclosure. A little background, first of all, on Compass IR. The partners here at Compass Investor Relations have been providing strategic investor relations advice to companies for 40 plus years between the four of us partners, and during that time we've been the Investor Relations Council for senior exchange IPOs with market caps totaling several $billion. We've assisted more than 20 new and dynamic companies to upgrade to exchanges, senior exchanges from OTC Markets. We've helped position private companies in the best possible light for interactions with their potential investors and other stakeholders. So we were really excited when Bob asked us to talk to you all today. And Bob has told us that many of you will be from smaller emerging growth companies where there might be a tension perhaps between pursuing best practice corporate governance and the competing demands on your time and money. And we also recognize, of course, that many of you are very active in the capital markets already and dealing with these issues every day. And we hope that the approach we've taken of starting from first principles and then providing some simple steps to improve your governance practices will at least help you think about what you're already doing more clearly and help you make incremental improvements and avoid pitfalls in the future. So first then, why corporate governance and disclosure? Why are they so important? First of all, the capital markets are highly competitive. Investors have several thousand US public companies to choose from, and many investors now consider investments in private companies also as a viable way to deploy their capital. So when competing for investor capital and for any other resources your company needs, for that matter, beyond investor capital, you need to recognize that superior corporate governance is highly valued by investors and by other stakeholders, regulators, your employees, suppliers, customers, and other stakeholders. And it's been shown that superior corporate governance and disclosure practices can improve access to and cost of capital for you all. And of course, responsibility for corporate governance and therefore the ability to attract the best resources on the best possible terms sits firmly on the plates of your directors, CEOs, CFO, right alongside their responsibilities for delivering great operating performance. Therefore, whether your company is newly listed or at a more mature stage with a wide shareholder base, we hope this webinar will provide ideas to improve your corporate governance and attract new capital, attract wider ownership, improve liquidity, and better relationships with all your stakeholders. So the idea that superior corporate governance produces higher returns to investors is hardly in doubt. It's been shown by a number of studies, including studies by Institutional Shareholder Services in conjunction with Georgia State University, CalPERS, and Harvard University and the University of Pennsylvania, that better governing companies have statistically significant better return on investment. They have better return on equity and returns in excess of market performance than their counterparts who are poorly governed. Furthermore, studies have shown that investors are prepared to pay a premium for superior corporate governance practices, or to put it another way, there's a direct link between the outlays of time and money on additional corporate governance initiatives and returns in the form of higher stock price, lower cost of capital, the liquidity of your stock, and wider share ownership. So, given the importance of corporate governance and disclosure, OTC Markets has asked us to give you some high-level rules of the road in this short format webinar. And having worked with hundreds of public companies, large and small, Elaine and I understand the struggles you will all face, not least of which are the constrained resources of time and money that you have. So one of the first things we often hear, especially from the managements of micro-cap companies when broaching the topic of improving corporate governance, is it's too expensive, or we don't have the resources to do that right now. However, given the evidence of cause and effect of outlay and return, why does corporate governance still wind up down the list of to-dos in the C-suite? We think it can only be either because of the underestimation of the return or overestimation of the outlay. So, having just made the case for higher returns, one of our remaining objectives here is to try to reduce the overestimation of the outlays on corporate governance that perhaps some of you have. And what we've done in this presentation is to break it down into the things you can do today that are easy and low cost to implement, as well as the steps or building blocks that you can take further down the road as time and resources allow. So on this slide, here's an easy and inexpensive one to start. It's got the easy button next to it. And what you should do is you should follow what we call the 4 C's of corporate communication. It looks simple, but I can assure you that we've listened to hundreds, if not thousands, of company presentations over the years, read many SEC submissions and reviewed websites, and we can tell you that a surprising number of companies do not follow the 4 C's. So let's briefly review them. Clarity. So the first thing to do is be clear. Strip down your investment thesis, for example, to 5 to 7 things that resonate with investors. Investors don't buy complicated, difficult to understand, or hard to remember. They buy memorable, impactful, easy to recall, and things that are convincing in front of their investment committees. So first thing, be clear. Second thing, be consistent. Avoid saying different things in different places. Avoid saying different things in your 10K, your website, your investor presentation, your press releases. Say the same thing across the board. And this is simple, just like effective advertising. You need reach, of course, presenting to lots of investors, but you also need frequency. Investors don't hear something just once and rush out to buy your stock. They might start to follow your company, and if they do, that's when frequency counts. They need to hear the same impactful, memorable investment thesis over and over. So consistency, very important. Of course, communicate in a way that's compliant with securities laws. There are obviously many of them, but Regulation Fair Disclosure, Reg G, and all the rules in Reg SK are obviously some of the examples. Finally, are you credible? In our experience, credibility is hard to win and easy to lose. Investors, journalists, employees, potential partners, unfortunately, rarely take your word for it. Even if your thesis points sound credible to them, they'll try them out on people they know and trust to triangulate your view with their own understanding of your thesis and the view of that trustworthy third party. So be ready to reference key opinion leaders who will endorse your claims, and be ready to back up all your assertions with credible data. In summary then, the 4 C's: low cost, big upside generators. Next, are you overestimating the cost of good governance because you think it's complex? Does it seem overwhelming? Are there too many things that seem important all at the same time? And one of the ways we think that's really simple to think about good corporate governance is simply put yourself in the investor's shoes. As public companies, you all have investors that you interact with on a regular basis, and those investors are a great touchstone in aiding your corporate governance and disclosure practices. Just simply listen to what they say and what they're concerned about. If you think about things from their perspective, you'll usually end up in the right place. So what do they say about corporate governance? And what follows, we're willing to bet that most of what follows will not be a surprise, but we're going to summarize some of the things which we think are important. So on the next slide, you'll see that we've drilled down to 5 key areas that we think investors believe are critical to superior corporate governance. So first, have great financial reporting, aim to be the best among your peers. Second, strive for a great board of directors. Third, show you can be trusted with shareholders' money. Fourth, talk to and listen to investors. And finally, keep the best company you can. So what we want to do now is we want to think about this list as a list of where you want to end up down the road, and we'll cover each of these things in turn, and in each case start with the easy steps you can take today and then consider some of the pointers we've given on some of the steps to take later when time and resources allow. So now Elaine's going to go over the first point, financial reporting.
Thanks, Mark. Okay, so great financial reporting. First of all, investors cannot evaluate an investment if they don't have the information. So what you want to start off with first is make your financial reporting systems among the best among your peers. And what do we mean by the best? Well, you want to strive to establish systems that deliver on-time reporting, meaning no 12b-25 filings. Remember, on-time reporting is a key insight investors have into the level of professionalism and the robustness of the financial reporting systems at your company. Just imagine if you were a shareholder and a board member of a private company. What would you think if you got a last-minute email saying the board documents had been delayed and the board meeting was being moved out 2 weeks? Well, the same thing is true of public companies. Shareholders become anxious. It doesn't help that most public companies offer a vague explanation as to the reason for the delay, such as accounting reasons or getting the numbers done would involve unreasonable expense. These types of disclosures rarely instill much confidence. Delays in reporting can cause other areas of concern. Delay can mean delayed release of non-financial information and delay of the investor conference call. It can mean the threat of delisting if it lasts too long. Debt covenants might even be triggered. So in all, companies that file late 10-Qs get a markdown from investors. Bitter experience tells them that they've just seen the tip of the oncoming performance iceberg. Second, you want to strive for excellence in transparency and answer tough questions when issues arise. Be prepared to discuss any material weaknesses in your financial reporting and explain why they exist and what is being done to correct them. And always use the 4 C's to discuss your performance and prospects. Make sure you discuss your strategy and not just reactive tactics. And be prepared for tough questions, especially in areas like those on this slide, including the use of capital, capital structure, executive and board compensation, as well as related party transactions. So what to do? We understand that financial reporting is one of the biggest challenges facing microcap companies today, and this is why the SEC provides an exception to the SOX auditor attestation requirement for very small public companies. Investors recognize this as well, and they're willing to cut you some slack if they know you have a plan to up your game. So you see the 1, 2, 3 icon here, and that indicates that the time to start moving towards best practices is now, but the route to best practices can be taken in several steps. So here are some steps that you can take to work towards superior financial reporting, starting with on-time reporting. Begin by bringing in the best internal accounting team you can and build it out as resources allow. This will allow you to attract a high-quality CFO when the time is right. Who is your outside auditor is a very frequent question asked by investors. And at a very early stage, a small, affordable auditor is perfectly acceptable. As you get larger and start approaching the SOX 404B threshold, think about moving to a mid-tier auditor. That said, and we'll discuss this a little bit later under Keeping the Best Company, keep an eye on whether your auditor has problems themselves. Investors check with the PCAOB and other sources, and an auditor with problems there will likely rub off on investors' perception about your company. We talked about the importance of the 4 C's earlier, so make it a habit to be clear, credible, compliant, and consistent in your communication. Even the SEC embraces plain English in your SEC filings. Next, great behavior starts with great policies. One of the first things we do with a new client is go over their policies, including their disclosure policy, board charters, and business conduct policies. And if they don't have them fully developed and in writing, we help them develop them. And you also want to make sure that you have buy-in from all parties involved and actually enforce those policies. So taking all these steps will reassure investors on many fronts. For example, they value your timely disclosure of material information and your high level of transparency.
Elaine, hi. This is Bob. I have a question related to those themes, and that is, what is your opinion on smaller market cap companies holding quarterly earnings conference calls? And then also, are there vendors that specialize in helping companies do that, conduct these smaller, for the smaller companies, the earnings conference calls?
Sure, that's a really good question. So my short answer to that is yes. Obviously in the spirit of transparency and communicating via the 4 Cs, definitely holding a conference call is where you want to be. On the other hand, you need to make sure you have, your ducks in a row lined up in terms of, your financial reporting is regularly, on time. We don't want to be sporadic in terms of only having conference calls when we have a good quarter and then skipping them when we don't have, such good financial results. So yes, ultimately, when you're prepared and in a position to consistently do a quarterly conference call, we certainly encourage small companies to do so. And, some companies, in terms of your second question, yes, there are vendors that can help. Obviously, Compass is a firm we do help assist our clients with financial reporting and, are happy to, write scripts and help them, get through that process.
Okay, thank you.
Okay, so next slide talks about getting control of your financial reporting. So there's many, many moving parts in the financial reporting process, as you can see on this slide. And on-time reporting requires planning and coordination. This is the old story that no one plans to fail, they just fail to plan. So one thing is certain on March 31st. In 91 days, it will be the end of your second quarter. So what we'd like to do is start with a timeline of deliverables and agree to timing and responsibilities. This makes everyone accountable for their role. We often help our clients by producing an earnings planning calendar that integrates internal resources along with external, like legal, auditor, et cetera, and get all their deliverables into a single timeline, and that helps keep everyone on track. Another important area is to try and anticipate any tricky disclosure issues. Perhaps you had a discontinued business unit, made an acquisition, or had a major contract. As early as possible so that you can build time into the process to resolve how you'll disclose this information. And if it's necessary to involve, internal and external audit, line management, and your counsel. So, the quarter won't always go according to plan, but it will end in 91 days. But starting with a process really helps a great deal. And these are just a few of the ways that you can move towards making your financial reporting the best among your peers. Now I'll turn it back to Mark to discuss the board of directors.
Okay, thanks, Elaine. Yes, so point number 2 then. Have a great board of directors. For smaller companies, the road to great may be a fairly long one, so let's start with the basics, noting that for investors it's all about quality and not necessarily quantity. There are no perfect recipes, and for everything I'm about to say, there are contra-examples. However, these are good rules of the road. Elaine and I, when we discussed this, felt that these were good things to share with you. So first of all, have independent board members, preferably in the majority as required by the rules of the major exchanges, and have members who act accountably and don't just tick the independence box. You need heads of board committees with a track record of success in these positions at prior companies if you can possibly get them. And if you can, back up the fact that you have these experts with expert justification statements with clear and verifiable claims to expertise in your disclosures in your 10K and proxies. And have committees that have clear and best-in-class charters and records of meeting on a frequent basis. Then disclose strong codes of ethics statements. Make sure that shareholders know your company will not tolerate ethics violations and they have a credible whistleblower policy. And show that the board is engaged and informed and involved, and at all times show that they do things like attend all board meetings, pick and choose their directorships carefully, and that your board members are not overcommitted, that your board members are prepared to ask tough questions and to push back against the party line when they disagree, and back this up with evidence if you can. For example, you might give an explanation of key issues raised by the auditors that were considered by the audit committee, and then give details of actions that were taken in response to those issues. Lastly, if the board's not doing a good job, the shareholders need to feel that they can do something about it. They need to see a board that's not set up to entrench existing management all themselves. For example, that you don't have staggered board elections, that the CEO and chairman are not the same person, that there are not dual classes of shares with all the votes held by insiders, and so on. And key investors should ideally meet occasionally with independent board members to verify that these robust discussions about the performance of the company are taking place with the directors, and that individuals they meet are fully engaged with protecting and directing the management. And investors are also likely to be encouraged by boards that evaluate their own effectiveness from time to time, perhaps with outside help, and make changes where appropriate. So, suggestions. Develop solid charters, codes, and policies that we just talked about. Start with the financial expert on the board and the members of the audit committee. And use your network to get recommendations of great board candidates and consider offering equity compensation. Find directors who have the additional value in that they may have connections that help the business grow. And finally, in terms of credibility, it doesn't hurt to have a board member who has significant credibility with investors and could serve as a triangulation point for the credibility that we talked about when we first discussed the 4 C's.
Hey, Mark, hi, this is Bob. So, yeah, obviously, attracting independent directors is an important part of the overall process. So speaking from experience, any tips and guidelines beyond what you mentioned here that companies could rely upon your experience? And also, are there websites out there that offer assistance for smaller or micro cap companies or other entities in looking at potential independent board directors?
Thanks, Bob. Yes, there are organizations that will recommend and even provide independent board members. But one thing that Elaine and I like to do when we start to work with companies, for lots of reasons, not just this one, is to say to the key executives, look, who do you know? Let's take a look at your contacts. And you find that in many companies, the senior executives are, well, this isn't a surprise, many of these people are very, very accomplished individuals with long track records in their industries, and they know a lot of people already. It's just perhaps they haven't written it all down. So we often find that just to emphasize the point that I make here is that your network is really one of the best possible ways to find new directors, Bob. But we would suggest that's the first place to start.
Right. Oh, thank you.
Sure. So I would say that on the next slide, what we're talking about is show you can be trusted here. Point number 3, and this is partly about erasing concerns. So how do you do it? First of all, you provide superior transparency and justification in all discussions of your financials, and Elaine and I have both talked about that already. And after that, maybe the best way to address the question of what the shareholders are worried about, reduce their concerns by in the following areas. Management, first of all, management is more interested in the size and scope of the business than maximizing returns because they want to diversify operations to reduce overall risk and keep their job. You don't want people thinking that. And it's hard to say exactly how each of you does this because the facts and circumstances vary for each of you. But one obvious area where that would come up is in mergers and acquisitions. Make sure in a discussion with shareholders about an acquisition, make sure that the discussion of the acquisition's rationale leads with its attractiveness to shareholders. Try and allay the fear that you're buying this to increase the size of your empire, that's not true, that in fact this is going to be a huge benefit to future shareholder returns. Second thing, management is trying to take value away from shareholders and keep it for themselves and their friends. They pay themselves large salaries and perks and do deals on a non-arm's length basis and spend money on non-optimal projects. Don't think I need to add too much as to why that's a concern. So just be ready to answer questions in these areas and respond in a non-defensive way to shareholder concerns by giving an explanation of the benefits to shareholders the issues that they're raising in these areas. And also, because shareholders worry that being in a minority as minority shareholders, that each of them has a small stake and that they don't have a seat at the table and can't discipline managers when they make decisions that harm them. So address that and address the worry that management may stay in their jobs when a better manager can be found, and hold on to free cash too long when they could pay it out to shareholders, and hold on to businesses when they could be sold or closed. You know, again, fairly obvious, but make sure that the board is seen to be doing their job at directing management as well as management doing the job themselves, and that shareholders are being protected. Next slide. So if you've accepted all those principles, for example, why would shareholders still be worried? Well, while those valuable and important measures of addressing those concerns are necessary, you still need to demonstrate that the company is being run for the maximum benefit of all shareholders, of course. And again, it's not possible to say exactly what a company should do to provide additional insurances to investors, because again, it'll be different for each of you. But again, here are a few sort of ideas that I think will help shareholders take notice, consider you to be well governed, and make them interested in your company. Provide evidence that the company's consistently competing and winning in its markets. Is the company increasing its shares in the right addressable markets? Is it winning more than its fair share of contracts against rivals? Is it introducing new products with increasing success? Is the company's moat, you know, the sum of entry barriers that's erected in its markets, getting larger and not smaller? Show that the company is doing exactly what its shareholders are doing, comparing its performance with that of its rivals and doing what it takes to outperform. When discussing performance, sound like a player on the court, not the umpire. Make sure you explain what you're doing as opposed to what happened to you. Embrace the market for corporate controls. To your shareholders, an offer to acquire the company is a high-class problem. Be ready with the answers about why the company should remain independent. And finally, show that the board's been involved when tough decisions have been made. CEOs who talk about key strategic decisions and add that these decisions were made with the full engagement of the board are going to be providing some additional comfort in this area to shareholders, and that is a good thing.
Mark, hi, this is Bob again. So sort of a question related to that. What about, from a consistency perspective, what about for a company that at some point was late with a quarterly or annual SEC filing? What's your advice as to how they recover from that, and how do they best communicate to the street that they're on the right track despite this speed bump that they hit?
So I think a combination of things, Bob. I mean, I think go back to Elaine's slide on process. Put a process in place so that you can figure out what went wrong. Make sure you're absolutely clear as to what went wrong in the first place, and then get that process in a position to fix the problem. That's the most important thing internally. And then you need to offer, in terms of communicating with your shareholders, you need to offer the 4 Cs. So now you're clear what you're doing. You can communicate that to your shareholders, and every time any of your C-suite executives is asked about this, they're going to have the same story, because they're all aligned in the same process, and get back on track, of course, in a compliant way. So I would say those 2 things: process and adherence to the 4 Cs.
And
right, that makes sense.
Sure,
Yeah.
Elaine here. I just had a little to add on that. I mean, we've worked with a lot of clients, and usually if you can make it within the extension window, it's kind of not as much of it is a ding, but it's not as much of a ding as actually you can't make it within the 12b-25 window. We've had clients and work with companies that have gotten so far behind that they're even a couple of queues late, and when they finally get, whether it's because of a restatement or just don't have the resources internally to get it done correctly. So even those types of companies can bounce back. When they finally get the systems in place, get caught up, they will need to re-engage with the market, and that's usually a good time to maybe put out a press release with all the information out there in the market, and just address and say, we have our act together now. Reporting is a priority for us, and come out and be as transparent as they can about it, and kind of reset, and then the investors tend to be a little bit more respectful of that.
Thank you, Eileen. That makes sense.
Okay, next slide. So our fourth point is to communicate with investors. And Elaine and I know from many years of perception studies conducted with shareholders with the investors and shareholders on behalf of companies, that investors really appreciate transparency and being asked for their feedback. So we would say talk to and listen to investors. And remember that communication has several parts. Yes, it is an act or instance of transmitting information, so definitely talk to the investors and use the 4 C's, but in addition, it's a process by which information is exchanged. So don't just talk, listen, and establish a rapport with your investors. It differs for every company, but once you communicate, you'll know what the investor wants to hear about. So an important part of corporate governance is telling investors about what they want to hear about. And when you know that, answer questions truthfully and directly, and note that promises made set expectations. That said, things change. So when they do, talk to investors and explain what has changed, what you're doing about it, and how they'll be affected, all in a straightforward and timely manner, and investors really appreciate that. So move on to the next slide and I'll show you some rules of the road. So as I said, answer the questions truthfully and directly, use the 4 C's, know your audience so that you can talk to them in ways and about things that are of a concern to them. When you're looking at the future, set clear milestones and meet them as best you can, noting that a forward-looking statement sets an expectation. So if things have changed, say so. And finally, be timely in your communication. And I know that although this slide shows the easy sticker, so we're trying to say to you this will be easy, it will only be easier if your internal communication is also excellent and your strategic thinking is clear. Final of our 5 points. Keep the best company you can, and this point is related to the idea of triangulation, the idea that you'll be judged by not just your past actions, which is a very important point, but you will also be judged by the company you keep. Investors are busy, and they look for shortcuts to evaluate your company as a potential investment, and one way they do this is by looking at who you associate with. And second, they ask third parties about you. And the more credible these third parties are, the more valuable their endorsement is. So be diligent in choosing your advisors. We've already talked about your accounting firm. So use the same diligence right across the board. If your advisors do check out as superb, then you're very, very fortunate, and that's fantastic. So try and raise your own standards to meet the standards of those superb advisors. But in every case, if you can, behave as though your advisors would be lucky to have you. Raise your own game. Push your advisors to improve as you improve too. So, what to do? Always look to upgrade your auditor, outside counsel, investment bank when the opportunity presents itself. We can't always start with, Goldman Sachs and Sherman and Sterling, but let's move towards the highest quality of association that you can get. And of course, your friends at OTC Markets are also very encouraging in that regard. And OTC Markets itself is a fabulous entity to be associated with. with. So they in turn are a very useful third-party endorsement. Companies on the OTCQX, for example, it's known that those companies, because they've upgraded to these higher standards, enjoy greater liquidity, higher market cap, broader shareholder base, etc. So keep the best company you can. So there you have our thoughts. Capital markets are very competitive. It's a crowded field. You need to compete and win for those vital resources. And great corporate governance is a significant unfair advantage for those who practice it. We've shown you 5 areas where we think you can improve your governance and disclosure in easy, cost-effective steps. And in the end, if you can be the best any shareholder can ask for given your circumstances, that's fantastic. Shareholders have a history of paying for the best. So the costs, we believe, are more than justified by the superior return. So Elaine and I thank you very much for listening. We hope you enjoyed the presentation, and we'll be happy to answer any of your questions.
Mark and Elaine, this is Bob. Thank you very much for an excellent overview on corporate governance practices. It looks like we have just a couple of questions at this point as follow-up. The first question we have is the person was intrigued by the performance of companies that practice good corporate governance procedures versus those that don't, and the stats that you showed. Curious, what's your observations? Is that across the board? Is it for a mega market cap versus a micro, or is it consistent across the board that you've seen?
So in those studies, Bob, they were mainly what they were mainly looking at were a set of companies that were ranked by these various governance quotients that the people who did the study were looking at. So I don't have data on whether they were able to break that down into significant differences between the effect on microcap companies and larger cap companies. But that doesn't mean that that information doesn't exist. And if anybody would like to give me contact details, I will certainly see if I can find additional information for them.
Sure, that sounds great, and you know, inherently good corporate governance practices it has to reflect that in the performance. The second question we have is the person wants to know if you've seen it more challenging for different sectors, you know, such as biotech or technology versus other more traditional sectors like finance or manufacturing. From a corporate governance perspective, is it more challenging for any particular sector? Is the question.
I'll let Elaine chime in as well if she has anything additional to say. I would say, Bob, the answer to that is that sectors will often go through periods of challenge. So, for example, an area that went through real challenge, of course, during the financial crisis was the financial sector, and certainly the REIT sector. So Elaine and I, when that was happening, when essentially the debt markets collapsed for the REIT sector, we found that they had particular challenges at that time, and we had a lot of work to do to communicate with investors to allay the fears there on behalf of our clients. And we, in one instance, we felt that investors were so concerned that we should make additional disclosures that, in fact, none of the companies in the sector were making this additional disclosure. I won't say exactly what it was, but you know, our clients said, look, you know, I'm not sure I want to really be the first out of the box here. And Elaine and I said, look, you know, the 4 C's, we believe that's something that investors really want to see, that the financial sector is in significantly challenged at the moment. We think you should make that additional disclosure. And when we did, in fact, our client received accolades from several of its analysts. who said, listen, this is absolutely fantastic. And then fairly quickly after that, a number of the peers, and larger, by the way, larger peers in the sector followed. So that's just to say that sectors can go through periods where they are particularly challenged. So I wouldn't say, necessarily that biotech is more challenged than high tech or whatever, but I would say that companies go through periods of extreme challenge and they need to be ready for it.
Right. And transparency it seems to be the theme throughout it all, right?
Yes, absolutely. If investors are concerned, you'll get a higher return by allaying those concerns, not by hunkering down and not saying anything.
Right. Well, those are the only questions we have at this point. So what I will do now is wrap it up, and I want to again thank Mark and Elaine from Compass Investor Relations for an excellent presentation. I also want to thank all of those that have listened in and attended, and remind those listeners that we will be sending recorded versions of this presentation directly to you as follow-up. So with that, I'll sign off, and thanks again to all.
Thank you, Bob.
Thank you.
Okay. Bye.